like all reform efforts, you put some of the hardest stuff up front and hope to build on that. I'm Adam Posen, president of the Peterson Institute for International Economics, and it's my pleasure to welcome back many old friends and new for a conference today on Abenomics' progress in reforming Japan's economy. We have gathered today a variety of people, all of whom are extremely well qualified, having been in the trenches of both analysis and action. And of course, we will be highlighted today by a luncheon keynote by Heizo Takanaka, director of Keio University's Global Security Research Institute, member of the board of the World Economic Forum, old dear friend of Fred Bergston and mine here at the Institute. In fact, Fred deserves credit for having had him as a fellow here before anyone in the US had a clue that great things were destined for Heizo, which they were. But we also have many other friends and colleagues who are here today, and I'm grateful to them and want to express that in front of all our friends watching online, that our colleagues at McKinsey Global Institute have delivered just recently, it turns out, literally I think this week, a new study on competitiveness and change in the Japanese economy, and they're going to be giving us some of their newest work on that. Our colleagues at the IMF Japan desk continue to be a source of unfettered but highly expert analysis, independent even within the building, I'm allowed to say, even though my friends at the desk might not want me to emphasize that. And we have the head of that group, Kalpana Kochar, speaking to us later today. But we also have distributed here and will be distributed on the website an excerpt from their new book on Japan, which I actually gave a back cover blurb to. So I'm a big fan of that. And of course, we have grateful to the support of our colleagues at the Sasakawa Peace Foundation and SPF USA, many of whom will be joining us for the last session on trade and international relations of Japan, taking the economics very seriously. I will introduce our various colleagues specifically. I'm just going to take one more minute to say, perhaps unnecessarily for this group, but I hope for the world at large, it's much too late to have forgotten about Japan. It's much too late to have given up on Japan. And it's much too late to be frustrated with Japan. Those are, of course, the emotions that many of us, both inside Japan and outside, have felt about the reform efforts that have gone on in the country, now the world's third largest economy, over the last 20 years. But as I've at least tried to argue in my own work, I think that that is a misleading and unfair characterization. Not so much because I need to have great sympathy for all the various prime ministers who've come and gone, but because I think it misunderstands how far Japan came under Heizo Takanaka and Prime Minister Junichiro Koizumi a dozen years ago, and the recovery Japan had in the 2000s, and how far Japan has come in recent years under the new government of Prime Minister Abe. We have had several events here, and we have stressed in particular, and I think rightly, what is referred to as Womenomics, the fact that female labor force participation in Japan is up 2% in the last 2 years. This is the best thing that Japan could have done for itself. This is real. We can trust labor market data in a way we might not be able to trust other data, and this is already showing up in the growth and temporarily in the downward pressure on wages, but will be a huge benefit to Japan in the years to come. But given that progress, we're choosing to focus today's events on two other areas. First, primarily reform in the corporate sector, which includes, of course, labor market treatment, equal treatment of women and minorities, but also more broadly issues of corporate governance, financial management, openness, and accountability. The ability of Japan to compete in a global context. We've got the illustration from McKinsey up there, but I'm also very proud this morning to be having Lindsay Oldensky of Georgetown and a non-resident senior fellow here at Peterson presenting her and Ted Moran's superb policy brief from last month, looking at the incredible record of resurgence of Japanese FDI in the US and the benefits from that, and we'll be having more on that. And then after lunch, we will be turning critically to the trade issue, where more than in any place else we can imagine that isn't a communist country, the opening to trade could be a huge reform lever in Japan. And at least nominally, the Abe government seems to understand this now. And I think a number of us are hoping that in time for Prime Minister Abe's upcoming visit with President Obama here in Washington, we will have at least the bilateral aspect of a TPP deal done. And of course, the highlight will be Heizo Takanaka, who's uniquely qualified to knit all this together. So that all having been said, let me now turn to my colleagues and invite Michael Chui of McKinsey Global Institute and Lindsay Oldensky of our place to come join me on stage for the first panel. Thank you. So, as I mentioned, competitiveness remains a key concept, no matter how many times economists try to kill it. And we all sort of know what it means, and in a sense, nobody knows better what it means in the practical sense than the scholars at McKinsey Global Institute. And we're very grateful today to have our friends from McKinsey provide some of the best of their people on their new project. Michael Chui, forgive my pronunciation.
Good.
Okay, is a partner at MGI, but he's worked on big data, he's worked on the Internet of Things, of course has a PhD, like any good scholar.
It's not necessary.
But has also worked extensively as a chief information officer in the public sector and the private sector, and has very deep Indiana roots. But I know that for the last couple of years has immersed himself deeply in Japan's economy, helping to lead the new report from McKinsey on Japan's global competitiveness. And I invite Michael to take the podium and lead us through.
Thank you. Thank you, and good morning. It's a pleasure to be able to introduce some of the research that we've done as a team at McKinsey. The McKinsey Global Institute has worked with our McKinsey Japan practice to take another look at the Japanese economy. And I'll highlight some of the workforce findings and policy options that we outlined as part of that research. And then my colleague Tasku will join on the second panel and describe some of the other findings that we had. It isn't the first time that MGI has actually looked at the Japanese economy. We actually looked at it back in 2000. And just by way of context, before I dive into some of the workforce implications, just to set a little bit of context. And at the time, we described Japan's economy as being two-speed. There were a set of export-oriented industries, advanced manufacturing, consumer electronics, et cetera, which we found to be global leaders in productivity, and the rest of the economy lagged. In the intervening couple of decades, or a decade and a half, the bad news part of the story is that Japan's productivity growth has in fact stagnated, not only in the broad economy, but even in those industries which we had identified previously as world leaders. And of course, during that time period, the demographic challenge has only increased. As folks in the room, I'm sure, are aware, Japan reached a tipping point in 2011 where the actual population began to decrease. And certainly the working population also is decreasing. Between 2012 and 2025, the working age population is projected to decline from 79 million to 71 million. And demographics is destiny. And of course, aging continues to increase. Even now, about a quarter of the population is 65 or older. By 2040, that share will rise to a third of the population. So all of those challenges exist. That being said, there are lots of tremendous strengths that the country continues to bring. Still the third largest economy in the world, and will continue to be so for the next decade with a great likelihood. Fourth largest export in the world, tremendous technical and technological sophistication, highly educated workforce, and a large and tremendously affluent consumer market. So there's room for optimism there, and certainly with Abenomics' first three arrows anyway, directionally appears to be making some progress, although still more work to be done, particularly on the third arrow. That being said, when we identified some of the enablers to growth in Japan, I'm going to call out 4 of them and mostly talk about the first 3. Number 1, new sources of talent, or sources of talent that are underutilized. Women, or Womenomics, as Adam mentioned. Increasing the role of experienced or older workers and immigration. Challenging perhaps, but increasingly necessary. Improving education and skills, whether strengthening the hard skills, where Japan does have strengths already, instilling more global mindsets, and creating a more robust education to employment pipeline. And then encouraging entrepreneurship, whether it's the attitudinal factors, improving funding in the legal environment or the context, and then creating an ecosystem, a broader ecosystem for innovation. And then a set of market-oriented reforms, but I think that'll be more of the topic of the second panel. So, again, let's just spend a few moments on female participation in the workforce, which Prime Minister Abe has described as Japan's most underutilized resource. Japan actually ranks 79th in female force participation and salary gap in terms of between genders. Of course, Japanese women are highly educated. Half of university graduates, as we show on this chart, are women, and they are very well represented at the entry-level professional level. However, female labor force participation does drop off precipitously. You could describe it at childbearing years, but also right around the time when workers enter management ranks. And if you continue to look at the numbers beyond that to executive ranks and board positions, of course, it looks a lot less like a funnel and more like a barrel with a tiny little hole in it. So that is extraordinarily challenging. Obviously, Prime Minister Abe's comment about an incredibly underutilized resource, absolutely true. And given the fact, if you're looking at growth, you're either looking at growth in the labor force itself or the productivity of that labor force. Addressing the female participation is incredibly important. Most concrete action, of course, is, there are a set of attitudinal factors, again, which I won't address directly. But the most obvious one, given this set of correlations, would be addressing childcare and increasing the availability of childcare. We do see examples of that being successful, for example, in the city of Yokohama, where dozens of facilities were added and moved from being the longest lines for childcare or longest wait times for childcare to actually evaporating those lines completely. Also, a set of tax incentives are around which favor single income or seem to incent part-time work by the second partner, which is usually the woman. And then also, while a majority of companies have reported implementing policies which would improve workforce and work-life balance, we do see additional opportunities to create targeted programs, particularly to improve the pipeline for women to move into management, whether it's mentorship programs, whether it's training programs, executive training programs, et cetera. Secondly, addressing the topic of older or experienced workers. Again, this is an existing strength of Japan. Japan has one of the highest labor force participation of workers above the age of 65. Roughly 20% of the population that's 65 or older is an active member of the workforce right now. And Japan has been raising its retirement age. But given the increasing need to address these labor shortages, and by the way, of course, not lose all that experience and skills, which a large part of that labor force will when it retires. We do see examples again where companies, and we've described it as the fourth arrow, right? It is the actions that companies can take right now because policy reforms have allowed these things to happen. The ability to actually create a more welcoming, effective place for older workers. And some of those things are just pure ergonomics, whether it's the speed of an assembly line, lighting, the work environment in which people work. But we do see additional opportunities to do that and examples of where that's happened. And then finally, let me just mention immigration. Foreign workers represent roughly 1% of the Japanese workforce. Compare that with peer countries. In Germany, 8%. In the United States, about 16%. And you know, I live in San Francisco. Roughly half of Silicon Valley tech companies have a co-founder which was foreign-born. And if you believe that diversity and a set of new perspectives actually underlies a lot of innovation and entrepreneurship, then you could imagine that actually having more foreign workers could underpin additional innovation and entrepreneurship in the Japanese economy as well. Now there is a basis for this as well. There are 140,000 foreign students in Japan, actually about 90,000 from China. You know, in the United States, we have a tremendous challenge. We're educating the world's, and then, you know, traditionally that's been a tremendous source, for example, for this Silicon Valley innovation. Unfortunately, some of our policies have pushed people out. Again, if you think about, you know, the Japanese equivalent, how could Japan actually encourage more of those people who are actually studying in Japan to stay? And also, again, back to the fourth arrow of private sector action. You know, we've seen some news recently about Japanese companies welcoming more executives that are foreign into their companies. So thinking about, you know, how to source global talent and how to develop that global talent within Japanese companies also could be a significant lever on the labor side. A few comments about education and training. Again, this is a strength of Japan. If you look at the PISA studies, Japanese students consistently have scored over the years in the top 10 in reading, math, and science. And it's actually quite an efficient system. You know, on a per pupil basis, spending is below the OECD average. So tremendous strength there. That being said, that some of what we're showing on this chart, for instance, that Japanese students actually rank lowest amongst OECD countries in their confidence in their ability to solve complex tasks and actually just even ask for explanations about things. So tremendous hard skills, but if you think about a world in which technology innovation is just increasing, the pace of change is increasing, the ability to develop what I've sometimes described as meta skills becomes even more important. So things like flexibility, experimentation, risk-taking, you know, leadership and collaboration. Again, trying to inject those more into the educational system would be quite powerful. Also developing more global mindsets. You know, while English is required in the Japanese educational system, Japanese students consistently score the lowest on test of English as a foreign language scores amongst OECD countries. And not that English is the only foreign language that Japanese students ought to be learning. It is certainly one indicator of a need to promote more global mindsets in the education system. And then the number of university students who are studying abroad in Japan has declined. For instance, in 2002, there were 64,000. 10 years later, only 34,000. And then finally, increasing the education or improving the education to employment pipeline, particularly around transparency. We find this as a global trend which needs to be addressed, but addressed in Japan as well. Better understanding, particularly as the labor force needs change, providing that transparency, not only to the educational institutions, but to the students who are making choices about what to study. And then a few comments about entrepreneurship. There's a funny issue maybe here with how that chart is being showed, but pay attention to the top numbers. So if you look at the percentage of the Japanese labor force that's involved in entrepreneurship, it's roughly 3.7%. That compares to 4.5% in France, 5.1% in Germany, 7.2% in the United Kingdom, and then 12.9% in the US. So again, just the sheer amount of entrepreneurship that's occurring in the Japanese economy is below that of its peers, in some cases far below that of its peers. And if you think about this need for productivity, it's going to be underpinned by competition. And that competition could come from existing Japanese companies, but in many countries it comes from new firms that are being generated through entrepreneurship. So it's incredibly important in order to push the productivity lens. A few policy or a few options, again, not just policy, that could underpin additional entrepreneurship. Certainly funding. If you just compare the United States, again, perhaps a challenging comparative with Japan, $24 billion worth of early stage funding available in the US in 2013. Since 1997, again, by one measure, Japan has only invested 113 million in angel funding. And it's not just the sheer amount, but also the degree to which potential investors understand the ability to do so. So there was a Ministry of Economics, Industry and Trade survey that showed a third of potential angel investors, wealthy people who could invest in these types of startups, were unaware of how to do so. And so one lever there is, the raw materials, i.e. yen, are there. The question is, how do you provide a platform? How do you provide the information so that investment can actually occur? And by the way, that occurs, that dearth occurs not only in the angel stage, but farther in the VC stage and all the way through IPO type funding. And then secondly, in entrepreneurship, just providing a vibrant ecosystem. And this is one thing that, I live in the Silicon Valley area. I think one of the things that we talk about is, many places have the raw materials, right? And Japan has the raw materials to a certain extent. World-class universities, educated talent, capital, tremendous infrastructure. But how do you actually combine those things together so that actually underpins entrepreneurship? And many times that actually has to do with the personal connections amongst people. And how do you actually create that? The education, the knowledge, one other, powerful vector is the ability to create ways to commercialize research that is being done in universities. So a set of things are around creating that context, creating a vibrant ecosystem around entrepreneurship. And then, as I mentioned before, supporting that in the education system as well, supporting the idea of risk-taking. Right? So it could be everything from venture competitions or just entrepreneurship competitions, projects within the school that would allow people to flex that muscle. So in sum, creating new sources of talent, addressing education and skills, encouraging entrepreneurship, and then of course the market-oriented reforms have the potential to underpin tremendous productivity gains, actually double the productivity growth rate in Japan. But the other thing that I point out is, to a certain extent, Japan is a leader here, and a leader in multiple ways. It's a leader in aging. It's a leader in technology. And these aren't just things that will improve the Japanese economy. If Japan can understand how to solve those problems, it could potentially be a leader for North America, for Western Europe, for China, other countries which have a similar set of issues, different, but a similar set of issues going forward. Thank you.
Just to pick up on Michael's rousing conclusion, I think there are two things we need to focus on in light of these kinds of very solid productivity recommendations. The first is that despite its recent downturn, Japanese productivity growth from 2002 to 2008, until the global financial crisis, was at the highest among the G7 economies. And the reason I bring this up is not just for scorekeeping. It's in the spirit of what Michael said. There is a tendency to say that Japan never came back. It was 2 lost decades, which contributes to sometimes the sense of hopelessness that some people have in Europe or in the US in various contexts. And it's important to recognize that Japan actually did come back for an extended period in the 2000s. But the second thing to note is, in a world where people worry a great deal about secular stagnation, and distinguished technological experts like Peter Thiel and on the investment side and Robert Gordon on the research side talk about us being at a fundamental slowdown or the absence of the next big thing, we've always known that there's still room for productivity improvement country by country, policy by policy, that nobody, certainly not the US and certainly not Japan, is fully at the frontier and fully efficient. And so that's many years of improvement remain available to all of us. And I think Michael and his colleagues have done a great job of emphasizing that in the Japanese context.
We'd point out that 50 to 70% of the productivity improvements that we've identified come from applying best practices which have already been implemented in other places.
Right, and there you go. I'd now like to turn to my colleague Lindsay Oldensky, who's been a non-resident senior fellow here at the Peterson Institute since December 2013, is also an assistant professor at Georgetown School of Foreign Service. She's taught previously at a number of schools, worked as an economist at the Department of Treasury, analyst at the Federal Reserve Bank of Boston. But importantly for our purposes, she and her co-author Ted Moran, who's with us today, have done a series of important studies, empirically grounded, very sound, and I think in many ways groundbreaking, on the impact of foreign direct investment flows both out of the U.S. and into the U.S. And a few months ago, I came to them and I said, some Japanese colleagues have pointed out to me that there's been a surge in Japanese foreign direct investment in the U.S. the last couple of years. Does this matter? Is this interesting? Is there anything useful you can say about it? Well, it turns out that thanks to Ted's and Lindsay's insights and their strong empirical work, there is something very interesting to say about this, I think, for all of us. And so I'd now like to ask Lindsay to come up and present their recent work.
All right, thanks, Adam. So today, as Adam mentioned, I'm going to be focusing on one particular aspect of Japanese firm strategy, which is their outward foreign direct investment, and specifically foreign direct investment in the U.S. And again, as Adam mentioned, everything I'm presenting today is from joint work with Ted Moran, who's here with us today. So over the past several years, outward foreign direct investment on the part of Japanese firms has been growing very rapidly. And for a while now, the U.S. has been the #1 destination for foreign direct investment leaving Japan. But in 2013, which is the most recent year for which data have been published, Japan was actually the largest source of inflows for the U.S. for the first time since 1992. In the intervening years, investment in the U.S. was dominated by mostly countries in Europe, as well as Canada and to some extent Australia. And this is a trend that's expected to continue when the 2014 data are released and then on into coming years. So what I'll be talking about now is what's driving that growth, both the push factors coming out of Japan as well as the pull factors on the US end, and more importantly, what are the implications of this surge in investment both for the Japanese firms and for the US economy. So this graph here shows outward foreign direct investment flows from Japan. So you can see there was an uptick in the late 80s, early 90s, that then fell in 92, remained relatively low until it started increasing again in the mid to early 2000s. And of course, it took quite a hit in the crisis years, but total Japanese outward flows have increased, recovered very rapidly from that, and are now above the pre-crisis levels. And this one shows the top 5 destinations of outward foreign direct investment by Japanese firms. And you can see the US has been at the top for a while, but particularly in 2012, Japanese investment into the US, direct investment, took off very, very rapidly. So why is this happening? Well, there's factors within Japan that make outward direct investment desirable. So first of all, demographics, as were mentioned, declines in the population lead firms to be looking elsewhere for customers and looking to enter other large markets, such as the US. The rate of return on FDI is also much higher than it is on domestic investment within Japan. However, there are a number of characteristics of the US economy that make it a particularly desirable place for Japanese firms to locate affiliates. And these are important for the Japanese firms, but also can give some lessons for Japan in looking at what are some of the characteristics that make a country a desirable location for attracting inward foreign direct investment. So particularly, US firms are much more globally connected and globally integrated than Japanese firms are. They do a lot more offshoring, they have much more international supply chains, and this is very important, and this is due to just corporate culture, but also very much due to relatively liberal trade policy on the part of the U.S. Also, many of us complain that or would argue that the U.S. High-skilled immigration H-1B visa program is too restrictive, but it's much, much less restrictive than immigration in Japan, and that's important as well. There's a much larger share of international and immigrant workers in the U.S. Than in Japan, and so this is part of this global connectedness that makes the U.S. a great base of operations, not just for serving U.S. customers, but for serving the world as a whole. And also, language is important as well, and there's a lot of the reason for Japanese firms to locate in the U.S. is the access to English-speaking workers, both in terms of connecting to these global supply chains, but also for things like sales, marketing, customer service, and so forth. So perceptions of Japanese investment in the U.S. have also changed over the past decades. In the 1990s, Japanese investment in the U.S. was met with a lot of fear, a lot of trepidation, a lot of concerns that the Japanese firms were going to keep the high-skilled work in Japan and just use the U.S. as a base for assembly. So there'd be a lot of imports, not much value added, and not many jobs for skilled workers doing research and development and other high-value activities. But this did not turn out to be the case. So I'll just highlight one study that was put out by the Peterson Institute by Monty Graham and Paul Krugman in the 1990s, which demonstrated very clearly that this was not the case, that U.S. firms, or that Japanese firms in the U.S. were doing very high value activities, and that they were increasingly relying on domestic U.S. suppliers. And today we see that that continues, that these Japanese firms are very important contributors to the U.S. economy in terms of the wages and benefits they pay, their total sales, the value added, the research and development, and both exports and imports from and to the U.S. So in terms of wages, we know it's been very well documented that multinationals pay higher wages, are much more productive than their purely domestic counterparts. And you can see that in the first two columns. But what gets less attention is that foreign firms, foreign multinationals in the U.S. actually pay U.S. workers higher wages than U.S. multinationals, which are the most productive of all U.S. firms. And if you look at the last bar, which shows the total wages and benefits paid by Japanese firms in the U.S. to their U.S. workers, that's even higher than the average for all foreign firms. So when Japanese firms are coming to the U.S., they're paying very high wages because, in part, they're doing very high value work, particularly focused in research and development. And so this shows R&D spending per worker, and I don't know if you can tell, there's a very faint blue line there that didn't show up quite as well in addition to the darker blue line. But for in 1997, which is the first year shown here, Japanese firms were spending less per worker on research and development than the average foreign firm in the U.S. However, that R&D spending on the part of Japanese firms increased much more rapidly. So you can see that by 2011, you have Japanese firms spending more than $10,000 per worker per year on research and development, whereas the average foreign firm in the U.S. is spending only about $8,000 per worker per year on research and development. And this is really important because this is important for the productivity of the U.S. economy. It's also important for creating these very high-skilled jobs. And so, I showed you the second bullet point there, which is the spending per worker, but also in absolute terms, the growth of total Japanese R&D spending in the U.S. grew by 160%, which is quite a bit more than the more modest 73% that total R&D spending by foreign firms in the U.S. increased by. And a lot of this is driven by software. So software patents have become an increasingly important share of overall patenting. And the US environment for software patenting is much stronger than it is in Japan. And you can see this by looking at the numbers of patents that firms have in software as a share of total patents in different locations. So of Japanese firms in the US, of all the patents that they get in the US, 24% of them are for software. That's compared to 17% among other foreign firms, and even more strikingly, this compares to only 6% in Japan. So for a number of reasons, this patenting environment in general, but more specifically, software patenting is really key, and is one of the reasons that Japanese firms are drawn to the US. And moreover, in previous work that Ted and I have done, we've shown that these, especially these high-value R&D activities, have important benefits for not only the firms that come to the US, but also for overall US productivity as a whole. And so we've shown that by just looking at very, very detailed firm-level data over a couple decades, that having a greater number of foreign firms investing in your economy leads to important productivity growth, not just on the part of those firms, but also on the part of the other firms in the industries in which those firms are operating. And so these are referred to as productivity spillovers. When you know, some of this can be just pure competition effect, but you also have learning by watching. When you have other firms nearby that are doing similar things, you can observe what they're doing and learn from it. When you have workers moving from foreign firms to domestic firms, they take their know-how with them, and this raises the productivity of all the firms, the domestic ones and the foreign investors. So, you know, thinking about strategies in Japan and productivity, taking advantage of these multinational companies and these positive spillovers is very, very important. So just to wrap up, you know, as you can see, foreign direct investment by Japanese firms is increasing globally, but in particular, it's been rising very rapidly in the US. And this investment is good for the Japanese firms. It allows them to improve their software patenting, to increase their global engagement, and also to get the higher returns to serve the large US market and to access skilled US workers. But it also benefits the US in terms of wages, the R&D investment, and most importantly, perhaps, the productivity spillovers that the US firms get from this.
Thank you. Lindsay, before you leave the podium, since you were admirably concise, in fact, more concise than our fellows ever are, myself included, I'd like to ask you, if you could, to expand just a bit off the cuff, maybe, on 2 points that I think are in your research but you didn't feature in your presentation. The first is just a bit of speculation or comparison on how and why the Japanese investment seems to be particularly high yield or high value added compared to, say, Dutch or British or others. And second, you and Ted, I believe, did some work looking at the auto industry in particular and whether that's what's driving these results. And so if you could say a few words on those things, I'd appreciate
Certainly,
it.
yeah. So I'll start with the second part, which is that the automobile industry is it's still the single largest area in which investment by Japanese firms is happening in the US, but it's still it's a very, very small share. So the total FDI by Japanese firms in the US breaks down about 1/3 manufacturing, 1/3 wholesale, and about 1/3 services and other. And of the manufacturing, it's, you know, it's just a small portion of that is the US. So it's the largest single category, but there's also quite a bit of investment, particularly in computers, electronics, semiconductors, chemicals. Then there's quite a bit in wholesale, and finance and insurance are also very large as well. So it's not just driven, there's a lot of innovation in the automobile sector. That's traditionally been one of the largest, the most important, and still is. But when you're looking at the importance of the R&D, it goes well beyond the automotive sector alone. And then what was the other question?
Well, just a little bit on, you sort of said this, but just to be clear, there are other wealthy advanced economies like the Dutch or the British who have particularly large investments in the U.S., but it seems like the Japanese investments look a little even bigger win-win than they do. So could you say something about why that might be the case?
So it's a combination of both the characteristics of the Japanese firms. So they are historically very strong technologically, and so they're able to do all this investment in R&D, but you have this technological strength on the part of the firms, which is then paired with a lot of very restrictive policies. And so you have firms that have the ability to do these types of activities, but just don't necessarily have the same home environment because of barriers to greater global market access, greater global supply chains, intellectual property, and so forth. And then, of course, another difference is the very similar corporate tax rates, similarly high corporate tax rates between the U.S. and Japan, which of course can't explain all of it, right? You know, Japanese companies don't have to come to the U.S. They could go to some place with lower corporate tax rates, but just relative to producing at home, that's less of a barrier to entering the U.S. than it would be for firms in other countries.
Great, thank you very much. So what we've heard, in a sense, from Lindsay in a very rich presentation of her and Ted's work, is still in the end something that echoes a lot of what Michael was saying, that this is outward-looking Japanese companies in part being driven by lack of best practice at home in certain areas, but that the underlying strengths in technology remain real even despite that. And so I think there's an interesting commonality there. Let me now open this up for discussion. If anybody has a comment or a question, you can direct it to either of our panelists. As usual, we have Jessica up front with a traveling mic. People sitting in back, if they wish, can go to the standing mic, and I'll recognize you if you could identify yourself. Yeah, so right there.
Thank you. Arthur Alexander from Georgetown. When I saw Lindsay, what happened to Lindsay and Ted's study online on the PIA online site, I thought this is
www.piie.com.
I thought this is just what I would have expected, because both from anecdotal evidence that so many Japanese R&D leaders have told me. For example, one guy says, have you visited our labs? I said, yes, in Kamakura. He says, no, that's not the good stuff. Go to Cambridge, Massachusetts, or Silicon Valley. That's where we're doing our good stuff. And the overall rationale that I hear for that is weakness of basic research in Japan and the software situation that you cite. And the software, I think, is tied to the innovation. The software traditionally in the US is done in small firms. In Japan, it was done in large firms. When we talk about, when I saw the innovation chapter in your study, I said, I got to see what he's suggesting there. Because one survey I saw said, asked people, would you want your daughter to marry one, an entrepreneur? And Japan was about at the very bottom of the list. And if you explain why Japanese households continue to put 50% of their savings into zero return deposits, it may help explain why innovation ranks so low in Japan. The difficulty of taking chances, of taking risk, is endemic. And as much as I agree with you about your improving the institutions, I wonder about the whole source of the lack of innovation as being something deeper and how you would attack that.
Michael, do you want to?
There are certainly tremendous challenges in attitudes around innovation and risk-taking. I think it is also important to remember that there are also positive examples of where not just Japanese companies going to other innovation hubs around the world, but in Japan have innovated, and there's a long history of that in technology. And so I think one of the things you can do is try to learn from those, because those are cases where in Japan that innovation has occurred. But I take your point as well, which is that while you can address some of the contextual, structural, and institutional factors, at the end of the day, innovation is driven by people and what people choose to do. And we can encourage that. We can encourage that through an educational system. We can encourage that through role modeling. We can encourage that through a number of things that, for management consultants, we fit in the category of change management, transformational change, et cetera. And it is important to address those as well.
Lindsay, do you want to add anything on that, or are you?
Yeah, well, I'll just jump in as an educator myself. This is something that Ted and I, and I'm sure you too, grapple with our students, with teaching. And it's difficult to teach innovation and to teach creativity, but we find ways to do that. And I think that it really lies in the educational system as well as the culture.
I mean, again, as Michael was, I mean, we're all kind of squeamish talking about culture. Arthur, you've been immersed in Japan for decades, and you're allowed to get away with that. But I mean, I do think it's important for Japan, but also, again, in the spirit of what Michael was saying, and I hope this whole meeting, what happens in Japan is not necessarily unrepresentative of what might happen with other advanced economies, and particularly with some other Asian economies. There was, I forget who coined it, but there was this wonderful expression from a couple of sociologists a few years ago referring to the Galapagos effect in Japan. That increasingly, if there was innovation, it was directed at totally the domestic market and not at things that could be universal. And the image everybody used, which sadly was appropriate, was the particular things for young Japanese women on their phones that were forms of software and hardware that just simply would not translate in the broad sense to anywhere else. And the statistic associated with this that I found most scary was that we saw a period of unremitting growth of Japanese women and men studying abroad, particularly in the U.S., and then that went down and continued to go down long after the acute crisis in Japan, at the same time when China and Korea and others were going up. And so in the issue of education that Lindsay raises, yes, I want to give credit to all of you who can somehow figure out how to teach creativity, but also we got to get people out there in different forms of education, and so that's been a worrisome trend as well. Let me recognize the gentleman at back, and then, Could
I build on that comment?
Please.
As we work with specific firms. A couple of things that we identify in our report and in the research. One is this idea that increasingly Japanese companies ought to be looking at global standards and being more open in their innovation processes and architectures. And so that's incredibly important, because I think the effect you describe sometimes is not so much about the customer need that Japanese companies actually address, but the ability to address that in a way so that it can actually be taken elsewhere. Mm-hmm. So there's a bit of that. But the other factor is that as we have work with clients who look at Japan as a market, and I think inappropriately decide, the Japanese customer needs and consumer needs are so much different, as you described it, than in another marketplace. And we certainly believe that consumers are different in different places and different markets, but I think that is often overemphasized. Yeah. And the ability for inbound FDI to Japan is another great opportunity, and one that would improve the competitive product, the competitiveness as well as productivity of Japanese companies by having to compete with MNCs going after the Japan market in a serious way.
Okay, I'm not going to resist throwing in one more thing on this. Some of you know, last week we had Richard Trumka of the AFL-CIO speak here, and we had a discussion about trade, and my colleague, dear friend Fred Bergston, raised an issue about barriers up and down, and who's breaking down more barriers, and I somewhat snappily said, well, remember, if you're not talking to Congress people, the reality is trade isn't about jobs, it's about productivity. And this is an important point. So a bunch of people spent years, both parties, complaining about, Japanese trade barriers, that they would insist, that you couldn't digest American apples or grapefruit, you needed different baseball bats, you needed different skis. And everybody held this up as saying, well, these are just these horrible trade barriers Japanese government is using to keep Americans out. But of course what happened was it didn't really cost the Americans much of anything. It cost the Japanese, because their firms were not forced to become more productive, their firms were not put under competitive pressure, and they didn't have to innovate. And so this is, again, an illustration. The trade is really, and we'll come back to this in the third session today, trade is really about knocking down barriers for your own sake. It's not about opening up markets in some old neo-mercantilist way. The gentleman at the back.
Mark Levinson with the Congressional Research Service. I actually wanted to build on the point that you just made, Adam. One of the sources, arguably, of innovation and productivity growth in the United States has been, particularly in manufacturing, has been vertical disintegration. And we tend to associate Japanese companies with much more monolithic soup to nuts enterprises. have we seen any trends in Japan that they're following the same tendency of U.S. companies in terms of disintegrating vertically, in terms of specializing and outsourcing things that are deemed by them to be non-core?
You guys, Lindsay?
Well, certainly the Japanese firms that are investing in the U.S. are to a much greater extent than domestically. And so, as I mentioned in my presentation, is one of the reasons a lot of these firms are coming to the U.S. is because it's much easier to do so here. And so that's been the focus of my research. I don't know so much about the domestic firms in Japan, but the ones that are internationalized look very much like other multinationals in terms of the degree to which they do vertically fragment.
Yeah, if you think about automotive, for instance, the tier 1, tier 2, et cetera, I mean, there are interesting kairitsu effects as well, but also the ability to integrate in thoughtful ways. So again, those, at least certainly the industries which traditionally had been global leaders, have been sophisticated about sourcing.
Great. I've got Alicia, Campana, Fred, and Harold. Howard, I'm sorry.
I'm Alicia Ogala at Columbia Business School. Just one other comment. The problems of Takata and the airbag industry, the world's leader supplier, is accelerating this trend. And the earthquake, the effects of the earthquake and the disruption on the supply chain, I think is driving some of this change as well. I had two comments, one for Michael and one for Lindsay. Michael, you referred to the world-class Japanese universities as a source of strength for future innovation, and I just wanted to repeat I'm not going to take responsibility for this comment. Mr. Takenaka made this comment in New York just 2 days ago, that one of the problems is that Japanese universities are not world-class, and when you look at the top 100 universities in the world, there's only 2 that occasionally make it into the ranking, and they're very low. I would offer my own humble suggestion that if you really wanted to change the idea of risk-taking innovation and education, that you would start in primary school and make it a feature of a child's evaluation to be the number of questions he asks the teacher and the quality of the questions, because as you probably know, that's completely discouraged. And I'll be short, but I had one comment for Lindsay. I was very intrigued by your figure about Japanese multinationals paying more than other companies in the United States. I'm from the financial industry, and I've looked at this with some headhunters. In the financial industry, Japanese financial companies hiring in Europe and the United States always pay top dollar. They pay top dollar because the American employee is making a trade-off. He is taking this higher salary knowing that he will never reach a senior level position, and that therefore also the turnover in Japanese financial companies of the foreign staff is quite high. Have you found that to be the case in other industries, or do you think that this is what would be your explanation for the ability to, or the desire to pay higher salaries?
Right. So I haven't looked at turnover, so I can't speak to that. But this is something that holds across industries. It's not unique to just finance or just automotive or any one area. It's across industries. And part of the reason is if you look at what they're doing, so it could be, I mean, it's really hard to measure, right? So I can't, there isn't data. I don't have measures on, perceptions of workers of these firms. So that could be part of it, I don't know. But what we do know is that it is spread across industries, and that the types of work that these firms are doing in the U.S. tend to be very high value added things. And so there's, when you get one effect, you generally have several causes. So we know that those are some causes, but it could be as well.
Your point's well taken about university quality, and obviously lots of different dimensions against which you can measure that. I do think you're right. The idea that what gets measured is what gets done. And of course, the trick is to have the right set of measurements, because, as we know from, for example, doing Salesforce work, people respond to the incentive, and it wouldn't be hard to teach someone to ask a lot of questions, and it didn't really reflect a lot of curiosity. So, I think your point's well taken. How do we actually measure and encourage and teach the behaviors and mindsets and attitudes that we think underpin success in an innovation economy?
Great. Campana.
Yeah, I wanted to confirm something that...
sorry, that's Campana Kochar from the IMF, will be speaking later.
Hi. Oh, sorry, I should have said that. I just wanted to confirm that in fact there is a lot of outsourcing going on by Japanese firms in Japan. But we did some work looking at the export response to the big yen depreciation that's taken place, and it's much slower than we would have expected. It's happening now. But once you factor in the outsourcing component, the outward FDI, it starts to explain much better what's going on. So it is happening, I think, to a much larger extent than people realize. The other point I wanted to make was on you know, we too talk about using more older workers more and so on. And at the same time, you talked about innovation and risk taking, and even in companies that not just in new companies, but even existing companies. To me, it seems like one of the things that's really holding them back is this very hierarchical structure in society where people simply don't question their elders because they're elder and so on. I think the only thing that's going to make a difference is to bring in talented foreign workers and have them be the ones that question the old ways of doing things. And I just don't see how that's going to happen in any period of time that we think is reasonable.
So to be clear, first of all, I also believe that there are older, experienced workers who can be innovative. But I think your point's also well taken that you know, a source of innovation can be immigrants. As we pointed out, it's an and, not an or. And then I think it is also important. I mean, you know, a friend of mine runs a startup. He brought his entire company to Japan for a month or two just to put them in a new place, and ran into this underbelly of Japanese software entrepreneurs who exist. And so, you know, that energy, that type of risk-taking attitude, that willingness to innovate does exist. It's not completely. So how do you accelerate that, scale it up, in addition to bringing in foreign workers, I think is important to think about as well.
Okay. Fred.
Fred Bergst at the Institute. Question for Lindsay. You presented this sharp rise in Japanese FDI in the U.S. as kind of a structural phenomenon. At least you implied that. You said it's likely to continue. An alternative hypothesis might be that this was at least in part a response to several years of a very strong exchange rate for the yen, as Kalpana mentioned. I mean, that had both a push effect from Japan. They became less competitive out of the home market. And, of course, it was a great time, if nothing else, to pursue your FDI plans in the U.S. in terms of the cost involved. Now, if that were the case, and since the yen has now weakened dramatically, maybe there would be a temporary burst rather than a prolonged structural burst. Have you looked at that variable as a possible explanation? What's your thought on its impact and its implications going forward?
So we haven't actually looked at exchange rates specifically. However, even given the latest data, so the 2014 data haven't been released yet, but Japanese firms continue to invest, both new investments as well as mergers and acquisitions. This is still going. There's certainly a lot of sound business reasons that they're doing it. So again, one effect, potentially many causes. There's evidence, even though we haven't looked at exchange rates, all of the other factors are so strong that it's just not something that could be completely driven by exchange rates, right? So clearly, the global integration, the R&D, the software patenting being one of the most important keys are things that are really not looking like they're going to change anytime soon. But that's a good point. We should identify the exchange rate effect as well.
It's also, if you look at Lindsay's chart, a little bit strange on the timing, Fred, because the surge continues in 2012 and 2013, and as you well know, there was a 20% correction in depreciation of the yen. We'll get to you in a second, Mustafa.
Corporate decision making obviously gets implemented with a lag, so the fact that the exchange rate began to change, that was over two years ago, it's begun to change. I would think that if that were a factor, it would now begin to show up going forward, but we would still see in 2013.
That's interesting. We should ask Lindsay and Ted, as experts in the FDI M&A literature, to look at that. My assumption would be that a lot of corporates, if you saw that material and exchange rate move in a short span of time, might call off a move. But maybe not. So we have the gentleman here and then Mustafa.
Hi, thanks. Howard Spector, Goldman Sachs. Actually, I wanted to follow up on another question, Lindsay, on FDI. Do you have any insight or have any thoughts into the nature of the funding of these outbound M&A deals from Japan into the U.S. or anywhere for that matter? Is it cash? Is it stock? Is there any thoughts on the leverage that's being taken in these M&A transactions, both historically and then going forward? Any view on, again, sort of the cash versus stock mix? Is it cash that's coming off of balance sheets, or are they using scrip to pay for the deals?
And which bank would they prefer?
Goldman, clearly. No, we haven't actually looked at that. That's actually a really good point. That's something that would be certainly very interesting to look at. One thing, though, that would maybe give kind of a clue into that is the fact that there was such a striking dip in foreign direct investment by Japanese firms in the U.S. during the global crisis years, and that's something that was relevant globally by firms from all destinations to all destinations. And so one of the main reasons for that was difficulty getting credit, in particular during those years. And so, this is just suggestive. Like I said, we haven't actually looked at any of the, funding details of these firms. But I would expect given that dip, might lead me to suspect that there could be some credit issues. I mean, that could also be driven by U.S. domestic demand on the part of the multinationals that are coming to the U.S. to sell to U.S. customers in the U.S. market. But in terms of the ones that are accessing global supply chains and so forth, then I would wonder if maybe that it reflects some sort of a credit issue. But I don't know. That's pure speculation on my part. As I said, I haven't actually looked at that data. It's a good suggestion.
Mustafa.
Mustafa Mahatran with General Motors. Following up on what Fred said, if you look at the first wave of Japanese FDI investment, it was in the mid-90s when the yen strengthened dramatically, and you could go all across Southeast Asia and see the Japanese moving as fast as they could out of Japan. The second wave comes obviously in the more recent episode of very strong yen. And I follow the auto industry very closely, and you can see, the Japanese auto companies have been very open in discussing that a key driver for them to invest in the U.S. was the currency. And you can already see, just in less than a year of a weak yen, that the Japanese are backing off or delaying some of the investment announcements in the U.S. So following up on what the IMF reported on, that yes, there's been a lag, but you can already see that exports from Japan are taking off. Japanese FDI is declining or slowing down abroad. So I think exchange rate is a much more important driver on these investments than you're giving credit for.
Please.
Go ahead, I have a separate question.
No, please go ahead.
Well, Priscilla Beck with Mitsui. It's a Japanese trading company, and one of the things that I guess hasn't been mentioned is the whole energy revolution in the U.S., which I think from an internal strategy perspective and for Japanese companies was a huge driver in terms of their desire to invest and the huge capital investments that were made. And then I think Mark had asked about the vertical disintegration. Just from my personal perspective, it does seem that at least for a lot of the trading companies, they still operate on a very a lot of their investments are still directed in a Japan-centric way in terms of trying to bring it back to Japan or finding a way to connect it back to Japan. And so the vertical kind of, they focus a lot on this value chain, kind of trying to combine every aspect of like the 360-degree, kind of our company motto. And so it's interesting to me as we're discussing it coming from the inside and from more of a U.S. perspective. It's a very different business model, and I think the decisions that they're making in terms of their investment in the U.S. They do take a global perspective, but a lot of it does come back to Japan's needs in terms of their energy and their what they see the U.S. being able to provide.
Two quick comments. The energy revolution, shale gas, light tight oil, has tremendous implications, obviously for not just Japanese FDI, but for U.S. domestic companies, the competitiveness of the U.S. economy. It has been revolutionary, not to mention the geopolitical implications as well. I'll leave it at that. And then, in our report, one of the things that we do identify is that there is tremendous opportunity to improve Japanese supply chain performance. And it is, in some cases, smart sourcing. But again, I think it would be an over-exaggeration to say, vertical disintegration hasn't happened. And of course, some of the U.S. firms are, and continue, and not just U.S., but other companies in general globally have tried to adopt some of the things that Japanese companies have done before in terms of improving their supply base collaboratively, et cetera, et cetera, et cetera. So they're sharing both ways. One of the things that we have found as we looked at productivity is that many companies outside of Japan arguably have adopted the best parts of Japanese productivity from previous generations of productivity increases, whether it's lean or otherwise, and in fact have improved their productivity above those of Japanese companies. And so that suggests, everyone has to raise their game now, including Japanese companies, and especially Japanese companies.
I just want to emphasize and thank the three people at this table for their emphasis on trying to see some of the FDI trends in the bigger picture. One of the great things that Lindsay and Ted's work does is it gets into the nitty-gritty and looks at firm-level data, but that obviously, by choice or by design, ends up not necessarily putting it in this context. And I think one thing to take away from this is if Lindsay and Ted are interested, is to have them not look so much specifically at Japan, but go back through the literature and their own work on the exchange rate or the energy price effects and how that's dealt with energy with FDI flows. I think that'd be really interesting. There's two gentlemen unless Ted wants to respond directly on that, there's two gentlemen at the table back there. Yep.
Greg Sheffley from the U.S. Labor Department. I'd like to raise some questions about the workforce and the ability to adapt to change. And also firms' ability to adapt the employment relationship with their employees. If you could address the issue of labor mobility and loyalty to firm, and also what improvements might be made to make a more productive workforce in Japan.
So loyalty to firm, obviously there's a long history of lifetime employment, et cetera. This is one of those cases where we've seen some of the structural barriers, some of the regulatory barriers to additional labor mobility be addressed. And so then it actually, we do think sometimes comes down to as we've described it, the fourth arrow, what is it that private sector leaders actually have the ability to do, and how much are they actually doing it in order to enable more labor mobility. So I think there's considerable opportunity, actually, on the point of both the employees as well as the employers to have more mobility. Now I think there's a lot more that can be done in our research. We talk about, for instance, the tremendous rise of call it contingent workers is another way to put it, right? Being getting up to nearly a third of the workforce, et cetera, and the fact that, in fact, we often view labor force mobility and contingent workforce as being an improvement in productivity because it implies lots of labor mobility. But having this underclass sometimes disencourages investment in their development, for instance, and in their skills building, et cetera. So, that sometimes that balance gets a little out of whack, and we'd suggest that perhaps in Japan that it has, and so that ought to be addressed. I'm sorry, your second question was just around improving productivity. Sorry, what?
Well, more on the employment relationship. You touched upon a little bit about contingent workers and part-time and other aspects of the firms adapting to, increased flexibility in the employment relationship.
Before you respond, Fred had a two-hander.
Yeah, lifetime employment point, like Alicia, I heard Hazel Takanaka speak earlier this week, and he said that only 20% of the Japanese workforce was now in lifetime employment. So that was really a diminishing phenomenon, and he suggested there was a lot more mobility now than there had been.
Yeah, and that's pretty well established, I think.
Yeah, we'd observe that as well. I think the mindset still exists to a certain extent, though.
But I mean, it is something that, you know, this is actually one of those parallels, Japan with Western Europe, if not U.S., that is underappreciated, is that there has been a major breakdown in the seniority system. So initially it was always overstated. It was only, you know, the biggest companies, the trading companies, the auto companies that had the lifetime employment really. And then it broke down for the new generation that came up in the recession. And then now with the initiatives on female labor force and other things, it's broken down further. And it presents many of the same issues as in Western Europe. It's liberalization, but it's also not necessarily, it puts a lot of pressure on people who are not used to pressure, and it's not always popular because it's not always equalizing. So, I mean, you're right to raise it. I mean, this is a very fundamental issue. Did you want to just come in on this? Okay. I don't know if we can get you the mic. Good. Well, hold on, because we're recording this for a transcript, so why don't we get all your pearls of wisdom?
I think as of January 2015, 38% of all workers are non-regular, as they call them. 22 amongst men, 57 amongst women. 68% of non-regular workers are women. That's something that, one of the things that we have actually in the book that's for which the flyers are sitting outside in one of the chapters is we're actually describing it as excessive duality. I mean, this flexibility stuff has probably gone a little too far. There are impacts on productivity because of the training channel. Non-regular workers are less trained. There's an effort channel that we describe over there. So I just wanted to confirm that this notion that everybody has lifetime employment is completely wrong and probably gone a little too far.
We're going back to that gentleman for the next question, unless anybody else wants to come in on labor markets. I'll just make a very shallow but important pitch. Those of you who join us in person at these events know that you receive lots of nice free copies of publications. And so for those of you who are here with us today, you will receive a copy of the new McKinsey report. You will receive a key excerpt, large, nice, pretty, from the IMF's new book on Japan. Our friends who are watching online or who come to the website later will be able to download some of these parts as well from our website, and I encourage you to do so, in addition to, of course, Lindsay and Ted's policy brief and others of our publications. Thank you for that commercial break. Gentleman in the back.
Felix Hüfner from the IAF. I basically had the same question on labor regulation. So I just wanted to make that one point, maybe Michael can comment on that it also has an impact on the willingness to go for entrepreneurship. Right, if you're in a protected, highly protected job, you're less willing to give that up and move into self-employment, and that may be, something you also see in Western Europe and in Germany. So even though the flexibility may be increasing, it may be for the young people who come in who may be less willing to go for entrepreneurship rather than those with experience.
Yeah, absolutely agree. That's a disincentive, and the non-regular worker issue is one that we agree with as well.
Yeah. Yes, please, if you could go to the back mic or just, oh, good, Jessica, fine, hand it to her. Sorry, I didn't realize you were there.
Thank you, Robin White, retired Foreign Service. Still on the labor force and looking again at women and Womenomics, I haven't seen too much breakdown, and I hope you can help me about where women are going to work. And the assumption seems to be that, the barriers are in the old line companies. Going back to the 80s and 90s when I was working in Japan, we found that the US Embassy and certainly the American and foreign firms coming in at that time benefited greatly from the fact that the young, educated Japanese woman applying for a job was far better than the young Japanese man. The young Japanese man had other opportunities. The young Japanese woman knew that in a big company she wasn't going to get anywhere, so she did wonderful things for U.S. firms and certainly for the U.S. Embassy where I was. So my question, I guess, to Michael is, are you looking at where the women want to go work and how that's going?
I do think there are limits to the U.S. Embassy hiring, but the truth is, we actually don't have hard data on women's work preferences. But that being said, I would say, if in fact there are large segments of the economy where women can't compete for whatever reason, that is not going to improve labor. That's not going to improve the incentives to improving labor productivity in those areas of the economy where you could potentially get the best people. So we do think that the ability to hire women ought to improve not just at the U.S. Embassy but through the rest of the economy as well.
I think. Again, we've done, including with consultation or cooperation, I should say, with our friends at the IMF, we've done some previous reports here on the Womenomics. And yeah, we've got to trace all that out. You're absolutely right. But I think it's also important, again, not to lose sight of the scale. Even though there's a lot of room for additional changes, particularly to the tax code and the child care and other such things, as Michael mentioned, we are talking a move of 1% in labor force participation overall. Well, 2% of female, 1% of the overall labor force, which is enormous. If you think about how in the U.S. we're debating whether or not there's still 1% left. And I know this wasn't your point. I'm not trying to take away from the specifics, but an interesting dynamic is that because these are, in a sense, the women who enter or re-enter are inherently less senior, as well as being victims of sexism. This is a downward pressure on wages in transition. And so even if we can hope that this is a permanent shift and moves forward, just as when the labor regulations changed in Germany after reunification and then again in 2004, there is a downward, and Felix knows this, there's a downward pressure on wages in that period. And we haven't been talking about macro side, but as my colleague Jay Chopra has pointed out and Angel Abide pointed out in Europe, the same thing, this is an argument for the multiple arrows in Japan, that if you're going to have this kind of labor force participation shift, even though it's long-term beneficial, it's another argument for the stimulus on the other side. Anyway, a bit of a digression. Ted, you've been very patient.
I am Ted Moran. I'm a senior fellow here at the Peterson Institute, but I also teach at Georgetown. Let me make an observation that will reinforce some of what Michael had to say, and it goes back to focusing on entrepreneurship, creativity, what Arthur referred to as cultural factors. So I've been teaching at Georgetown for more than 20 years, and I would say when I began at this Jesuit institution, it was much more of a passive, obedient, lecture institution. And now, as Lindsay knows, we're all about case studies, oral, where there's not necessarily one correct answer, oral presentations in the classroom, teamwork. I'm sure it's the same at the Columbia Business School. So that's one generation. I mean, in 20 years, you really can turn things around if people would listen, Michael, to some of what you would say. Now, is the problem with the students? The big problem is with the faculty. I mean, you have to get faculty who actually are willing to change what they do, or you have a generational change to younger faculty. But it seems to me that you can change culture, at least at the margin, within a generation.
That's exciting. So at least you've already gone. So the lady in back there, if you could, please.
Yes. I apologize. I was a little late, and I may, if you spoke about this, forgive me, but
I'm sorry, your name, please.
My name is Kim Frank, and I work at the U.S. Government Accountability Office, and I had a chance to go to Japan several years ago to look at what they were doing to promote the manufacturing sector. And the small and medium-sized enterprise sector and kind of applied R&D seemed to be where a lot of, there was a lot of energy and there was a lot of very interesting stuff happening. So I was wondering if you might be able to speak to that as a sort of a bottom-up source of innovation and growth for the Japanese economy.
It's certainly, in some ways, it's easier to turn a smaller ship, and so innovation and growth in smaller, medium-sized enterprises, I think, is definitely a potential source of innovation. The other thing I think it's also worthwhile to recognize, and perhaps less in manufacturing, although to a certain extent there, certainly we found it in retail, is that not having scale, not having sophisticated management can be a significant drag on productivity as well. And so in some parts of the Japanese economy, additional consolidation, the application of scale, the application of technology, and the application of more sophisticated management can underlie significant productivity increases. And we think that, that there's real potential to do that, in addition to finding true innovative, driving innovation through smaller firms. Yeah.
Great. What?
Can I continue on that?
Sure.
Yeah, unfortunately, not all small firms are innovative.
Yeah. I want to continue on this point that you mentioned something very interesting earlier, Michael, that there's this underbelly of software developers. And there is a professor at UC San Diego, Ulrich Schady, who's done a very interesting study looking at about 10 firms who have the highest returns to capital. These are very, very different kinds of firms than the standard hierarchical firms that we know. And one hypothesis is that there are these smaller firms who are not like the older firms who may be bubbling up to the surface. On the other hand, there may have always been this underbelly of small, productive, innovative companies who have never gone anywhere. And so I would say, here's a great research project with the capabilities of your institution, your company, to see whether this is something where these new, younger, dynamic firms, smaller ones, will replace the old ones, produce a new Japanese economy, or will they just continue to kind of bubble along at the bottom and never go anywhere and just be this little layer of yeast that doesn't rise the loaf?
It's a terrific question. I would like to believe there have always been innovative people. The question is, how can you scale that innovation?
Yeah, well, and the other point on that, and this is true not just in Japan, but everywhere, is that it's the most small firms are not necessarily innovative or going to grow, and it's hard to identify the ones that are. Think about small businesses. It's, dry cleaners and things like this, and even in manufacturing, many of them are not small. So the keys are looking at things like it's not just small firms, but it's new firms and growing firms as well. And so I think it's important in Japan or anywhere to caution against focusing too much on small businesses, but to identify what type of small businesses, which are a very small minority, might have the potential.
I want to strongly commend Lindsay's caution in two senses. First, there's been a bunch of work done, particularly led at the OECD, but also World Bank and elsewhere, on sort of demographics and life cycle of firms, and the key seems to be those small firms that scale up, which relates to Michael's thing. And again, it's not about the barbershop or the cleaning service. It's about the small firms that grow. And one of the key differences, say, between U.S. and Western Europe that's often remarked on is that you don't see the same expansion of even leading small firms. The second thing is our colleague here at Peterson Institute, Carolyn Freund, has a new book coming out in the next couple months, but building on her academic work on the idea that almost every country, without exception, whether it's rich or poor, tends to have a couple leading export firms that provide the bulk of employment growth, the bulk of export growth. And this is very much in keeping with where the state of the art literature is now. And so while there is a tendency, understandably, particularly after the financial crisis, to be concerned about the incumbent large firms, it's very hard to get away from the idea that Japan needed a Toyota or a Sony just as the US needed a Boeing, GM, Caterpillar to advance, or just as Finland needed Nokia. You can't really quite get your success away from those large firms. This has been a great discussion. I'm grateful to my panelists and to everyone for engaging so much. Alicia Ogawa gets a last question if she wants.
I wanted to ask Michael, I assume that you deal with a lot of VC companies who are looking to invest in Japan. I regularly interview VC companies when I go over there, and the complaint I always get is that, yes, there are innovative small companies and they have very exciting new technologies, but that they don't want to relinquish any kind of control over decisions to outsiders, as VC normally expect. They don't want to give away equity, and they also complain about some of the taxation, both the high corporate income tax that that Lindsay referred to, and also the high inheritance tax that they claim is a disincentive to entrepreneurship. I wondered if you had any comments about any of that.
This is anecdotal as opposed to I've heard about all the rest. I haven't heard as much about the inheritance tax issues. But then again, my VC friends would say the same things about California entrepreneurs.
I got to thank, I've already thanked them for their substance and their graciousness, but I have to thank Lindsay and Michael for showing those of us old farts that you can be pointed and concise, unlike some of us who tend to rattle on. And so that means we have ended on time after a very lively discussion. We will reconvene at 10:45 under Ted Moran's chairmanship for further discussion about corporate governance issues and corporate reform in Japan. Thank you all very much.